Our club has always been a forum for public figures, thought leaders, and decision makers to share their ideas. Here, we offer access to dynamic political, business, and public personalities.
We are dedicated to encouraging debate on the issues that matter to this city, this province, and this country.
The Canadian Club is one of the most important podiums anywhere in the world that a Canadian can speak to, tell Canadians what it is that they think, develop those thoughts. And so I want to thank you for that very, very much.
Please join me in thanking our esteemed panelists today.
Through our programs and events, including our youth and young leaders programs, our diversity partnerships, our joint events, and our media and social media opportunities, we offer you access to dynamic political, social, and business figures from abroad and right here at home.
The platform from which the eloquence of Canada has flowed all of that time, whether it be business, education, politics, sports, arts, and culture. If someone wants to say something to Canadians about this country and about the future of this country, this is the venue you choose.
Good afternoon, Canadian Club members and guests. My name is Joseph Lowe, President of Canadian Club Toronto, and I am so excited to be your host today, especially for our season opening event. So, on this first week of school in Ontario, I appreciate you joining us for an exciting, electric new season of the Canadian Club as we continue to celebrate 125 years of speaking to Canadians. Today, we have many guests joining us digitally, as well as, of course, here in the room in person. But no matter where you are, please do engage with us. You'll find hashtags on your tables, and you'll see those on your screens as well. As children in Ontario return to the classroom, and a new academic year this week, many of us might have been transported back to a cherished back-to-school memory of our own. I know that I was. That shiny new lunchbox that we were carrying. The coolest new runners that we've been saving all summer. A fresh notebook with all those multicolored tabs ordered just so. Just saying hi to the teachers who would become our favorites and would in fact make all the difference to us in our lives. Like many of you, my wife and I were helping our 11 and 12-year-old pack for their first day of school a couple of days ago. Let me tell you, their notebooks were emblazoned with apples and androids, not so much my colored stickers. So my question to all of us is this: when we think about pensions and retirement, has innovation in that space kept pace with the innovation that we'll find in my kids' backpacks? Seriously, has it? Well, this afternoon, we're going to find out. Our speaker is, after all, entrusted with expanding the retirement horizons of Ontario Teachers' 330,000 members. As he shares his remarks, let's pay particular attention to how he intends to lean in on innovation, international expansion, and impact in today's complex investing environment. As a global investment powerhouse with almost $250 billion in assets under management, Ontario Teachers operates in more than 50 countries across 5 continents, managing over 100 private investments today. Joe Taylor, OTPP's President and CEO, will share his vision and strategy with us to grow the pension fund to $300 billion by 2030. Our conversation will be moderated today by none other than Andy Willis from the Globe and Mail. And so if you have any questions for Joe through the course of the conversation, please jot it down. You'll find the Q&A cards right on the table. And if you're online, you can hit the submit a question button at any time. We'll get your questions that way as well. Now, I'd like to acknowledge our sponsors for today: PwC, represented by Ryan Covrette, and McCarthy Tetro, represented by Scott Bell. We very much appreciate your support. So now it's my pleasure to invite Ryan to the podium to introduce our speakers today. Ryan, over to you.
Thank you, Joe. It's amazing that we're actually here in person. It took me 5 seconds from the time the chicken was delivered to dip my tie in it and get it all over my shirt. So if you're taking the photo, this side is better right now. Thank you. As Joe mentioned, my name is Ryan Couvrette. I'm a partner, private equity, and pensions leader in the GTA at PwC Canada. I'd like to extend a thank you to Joe Lowe, president of the Canadian Club, my colleague at PwC, who invited us to participate in this event. It is my absolute pleasure to introduce Joe Taylor, the President and CEO of Ontario Teachers' Pension Plan, and our moderator, Andy Willis, business columnist at the Globe and Mail. Joe was appointed President and CEO of Teachers in 2020 with a goal of reshaping Teachers' brand to be bolder, bigger, and more entrepreneurial. Joe and his leadership team recently announced a total fund net return of 1.2% for the 6-month period ended June 30th, 2022, and a 1-year total fund net return of 8.3%, delivering positive returns for its members at a time of immense uncertainty and volatility. Andrew Willis, as we've mentioned, is a business columnist for the Globe and Mail's Report on Business. Andrew has been in journalism for 30 years and is a former SVP Communications at Brookfield Asset Management. Today's session will explore the macro shifts that are influencing the global investment landscape and how Teachers is navigating the investment opportunities and challenges during this difficult social and economic climate. At PwC, we recently launched the Trust Roadmap, which seeks to address the growing trust deficit that individuals and organizations are experiencing today in light of these challenging times. It is our purpose at PwC to build trust in society and solve important problems, which we believe is crucial during times like these. Thank you, and I'll now turn it over to Joe to offer his opening remarks. Joe will then sit down with Andrew for what promises to be a very engaging discussion. Thank you.
Well, thank you, Ryan, and it's my pleasure to be with you all today, and thanks to the Canadian Club of Toronto for the invitation. Before I started talking, I had that classic speaker's moment of vanity over accuracy. So I'm talking without glasses, so if I really stumble badly, it's because vanity took over my approach. Two really helpful introductions made already by Joe and Ryan, but I did think I'd just take a few minutes to share a few words about Ontario Teachers for those of you who are a little less familiar with us. As has already been said, it's really our role to invest to deliver retirement security for over 330,000 active and retired teachers who are predominantly based in the province of Ontario. We also administer their pensions and make sure that we can provide a high mix of service to deal with their issues and their concerns. And as already been said, over the last 30 years, we have grown to be a global investor with around $242 billion in net assets. And our investment portfolio spans everything from airports in Europe, apple orchards in the US, and autonomous vehicles in Asia. And as I'm sure many of you will know, we also own Cadillac Fairview, which is a well-known local operator of shopping malls and office buildings, which is now looking to expand beyond Canada into different segments of real estate. Now, unlike most pension plans, we manage 80% of our assets in-house, and we're very engaged with all of the businesses that we work with. We have a team of over 400 investment professionals who sit on our company boards and work towards moving them to be both more profitable but also more sustainable. And this active approach is critical for our ability to pay pensions. And the reason for that is that our member and employer contributions account for only 20% of our funding sources. The remaining 80% we have to generate through investment returns. And adding to this challenge, we have the demographics of our plan. Our members, on average, work for longer than they pay into the plan. And this means that pension payments far exceed contributions. Now, unlike many of our peers, we navigate a multi-billion-dollar funding gap each year, and that's going to widen in the coming years. So given all of these realities, one thing stands out. We really can't afford to make too many mistakes. So this leads me to my remarks, and I'd like to highlight some of the challenges that I've faced personally over the last 3 years, some of my learnings to date, and then also a brief look into the opportunities for the future. And then, as you heard already, I'll be able to have a chat with Andy over Q&A, and I do hope you get the chance through that to pose some of your questions. So when I started as CEO of Teachers, I saw 3 early challenges: to get a deeper understanding of the business, to establish followership, and to set a new North Star for the organization. So on the first challenge, when you think you've been with the business for a reasonable length of time, a decade in my case, you work on the assumption that you know the business pretty well. I actually discovered that in addition to moving to a new job in a new country, there were aspects of Teachers that I didn't know quite so well. And the reason for this has already been mentioned, I think, which is Teachers is a complex organization with investments in over 50 countries across a wide selection of assets. The second challenge for me was actually to build confidence in my leadership. I knew that if I was going to achieve what I wanted to as CEO, I had to build followership, starting with my senior leadership team, many of whom had been my peers until quite recently. I had to persuade them that I had both the right vision, but frankly, I knew what I was doing. The third challenge was actually to find a North Star for the business, which has already been mentioned. The one that we chose was to reach $300 billion in net assets by 2030, roughly 50% more than the $200 billion that we had when I was appointed. Now, while $300 billion, sounds like a nice round number, it actually is the number that we need to achieve to make sure the plan remains fully funded in 2030. So, back to January 2020, if you can all remember that far back these days, I came into the job as an optimistic CEO, ready for the challenge. What I didn't expect was how much the environment would change and just how quickly. With the impact of the pandemic, almost nothing turned out as I first expected. And in that, guys, I thought I'd mention 5 things that were, to me, the most notable. First, the COVID pandemic created unprecedented disruption for the world and for our business. The first major challenge for us was to engage full remote working and to actually test all the systems and working practices that we'd set up for such a crisis. In the face of uncertainty, the team did a super job of reacting quickly and actually moving to full remote working and different working practices that came with it. And I think now the worst of the pandemic is hopefully over. We will all need to decide what is the best approach to both in-office work and remote working. And I believe navigating these conflicting needs will be one of the defining issues of 2023. As, if you think about it, we're trying to show enough flexibility so that there's sufficient in-office experience to give a good experience to those who come into work, but also we're showing sufficient flexibility to high-quality younger staff who actually currently see an in-office 5-day working week as, frankly, quite unattractive. My second issue is geopolitics, and I think that's become increasingly strained around the world. We now have in Europe a war, which I think nobody really saw coming. The working relationship between China and the US, which was once the linchpin of economic growth and stability, is incredibly strained. These developments are fueling volatility and uncertainty in global markets and prompting many of the investors we know to hunker down and focus on investing in home markets. And as you'd expect me to say, my third point is soaring inflation. Higher costs of both energy and food are hurting families and businesses around the world. And central banks have moved in an effort to deal with inflation by hiking interest rates, something you saw locally yesterday. But that higher rates is bringing other challenges. And the risk of stalling growth or stagflation is a really material one for our plan, but also for many other businesses. This is forcing us to rethink how we look at our capital deployment. My fourth point is actually now the accepted urgency around how we need to tackle climate change. And this issue has put a lot of pressure on investors to act now to reduce their carbon footprint, but also the footprint of all of their portfolio companies. The more progressive investors are now starting to think about picking up the challenges to proactively invest in reducing emissions in more high carbon intensive businesses. And finally, of my list of 5, I think we're also changing differing environments and thoughts about stakeholders and expectations of those stakeholders. Trust in government and large institutions like teachers has waned. Increasingly, the onus is on us to demonstrate that we have a purpose beyond making a profit. So what have I learned in the past 3 years? Absolutely, my first point would be to say that as a CEO, you're only ever a transitory occupant of a really privileged position. Teachers had 3 excellent CEOs before I was asked to do the job, and there'll be further great ones that'll take the role after I go. It's really my job to make sure that I leave the organization in a better shape than when I started. It's a responsibility, I think, to wear with purpose, not with apprehension. Second, you can really only achieve success with the right people. Rising to the challenges we faced over the past 3 years was certainly not easy. It was achieved thanks to an outstanding team where we're able to make those changes throughout our organization. The team has shown incredible adaptability in very trying times. My third point would be to say that we're very fortunate at Teachers to have a diversified approach to portfolio construction. And this has helped us to adapt in what have been fiercely negative investment markets to allow us to be able to show stability and growth to make sure that we maintain a fully funded plan. And that being able to do this with speed and agility is in no small measure a feature of history. As a historian, I like lots to talk about history, and that was really down to how Teachers was set up over 30 years ago. Our governance structure, which was designed very wisely by our sponsors some 30 years ago, is one of the key reasons we were able to act really decisively starting in 2020. Our sponsors chose to choose a professional and independent board, which has in turn has delegated some authority to the executive team to run the plan. And this approach to governance has become internationally as the Canadian model, and it is, in my opinion, one of Canada's greatest exports. Canadian plans differentiate themselves by being able to attract the best talent, invest directly, and also to switch rapidly between public and private investments, all of which help to boost our returns over the long term. And I think it's true to say that many investors around the world are now trying to implement their own version of this model with varying degrees of success. Our model empowered us to act quickly and with conviction to deal with challenging market conditions. And I just thought I'd share an example of which I think highlights it pretty well. Back in March 2020, fixed income represented 46% of our asset mix. When COVID impacted rates fell to near zero, we acted quickly to unwind both the scale and the interest rate sensitivity of that portfolio. By December 2020, our allocation to fixed income had been reduced to 16%. Now, sometimes percentages don't give you the full picture, but essentially what we did was to switch over $60 billion from fixed income into other asset categories, predominantly private companies. Now, I don't want to leave you with the impression we've got everything figured out. Navigating all of today's challenges is very much what I would call work in progress. We need to continue to invest, but more importantly, we need to continue to take risks in what will probably remain to be very volatile markets. The next 10 years look like they'll be very different from the last 10, so our investment strategy needs to adapt to be able to reflect this. And with this backdrop, as Joe mentioned earlier, I thought I'd cover 3 areas quickly around how we see opportunities for the future. And that's international expansion, innovation, and impact. Now, despite the more complex global markets I referred to earlier, we'll continue to diversify our portfolio and our team internationally. While we invest in over 50 countries, we're focusing on 9 or 10 strategic markets where we believe we have both the competitive advantage, where we also have the necessary expertise. And these include some long-standing markets, places like here in Canada, the US, and the UK. But also more recently, we've been exploring new markets such as India and Mexico, where we've been quite active over the last 12 months. And we're deepening also our focus on innovation. And that includes investing in high-growth companies where we think they're likely to benefit from changes in technology and consumer behavior. 3 years ago, we created Teachers Venture Growth, a team that now works with over 20 companies in sectors ranging from digital healthcare to plant-based foods. It currently represents about 3% of our portfolio, and we plan to grow that to between 7 and 10% over the next 10 years. We're also bringing innovation to all of our portfolio through Koru, which is our incubator. Koru works with the companies in our portfolio to identify opportunities to create standalone businesses or new products that can be spun out and can succeed independently. And I thought I'd give you an example. So one of those companies that has been set up is something called Field, which designs software which allows you to monitor the safety of staff in the workplace. And Field came out of our partnership with a UK gas utility, SGN. And they have a number of staff working in remote areas all around the UK. And since the Field app was developed, SGN has seen a 20% reduction in work injuries and also an 8% increase in profitability. And there's also been quite a lot of interest from third parties to license the technology for their own workforce. And having said all of that, I do want to make the point that at Teachers, we do want to have a positive, lasting impact on the world. Our active management model has helped us to shape our approach, for example, to climate change. We believe the best way to accelerate the energy transition is by engaging with high emitters rather than passively divesting. And that active ownership approach and the ability to invest in both public and private companies has meant that we're well suited to help with many larger businesses to decarbonize. And finally, for our investment strategy to succeed, we'll need to promote a more distinct brand for Teachers. And this is particularly true internationally, where we're often seen as one of the Canadian pension plans. And let's be honest, whilst that means we're in good company with that characterization, it does not help us really to be able to work with the very best investment partners or equally to secure and retain the best talent. So I hope my remarks and the Q&A coming up next with Andy gives you a good sense of who we are, what we're trying to navigate. I also hope that you see an institution that is well positioned to handle all of the challenges we'll face around the world, capitalize on the growth ahead, and create a meaningful and lasting impact on our chosen markets. And finally, I wanted to make a couple of other comments, if I may. So firstly, I noticed that our sovereign's health is suffering today, and I know a lot of the royal family are gathering, so certainly my thoughts go to somebody who I think has shown massive leadership throughout my life in terms of her actions and her contributions around the world. But let me bring it back to home and really reinforce what was said a minute ago, and that is to say that many of our members, along with 2 million children in Ontario, are returning to school this week. And I want to add on my best wishes for the start of this school year, and I hope it's a massive success. But from my role and my responsibilities, I also want to make one final point, which is that I wanted to reaffirm that we'll continue to work with our members and work on their behalf to reduce the financial anxieties of retirement when they choose to take it. Thank you very much.
Well, thank you very much, Joe. And thank you, everybody, for being here as we start the season. I have to humble myself for a moment. The fact that I am up here with a CEO of Teachers tells me that no one at Teachers has read what I wrote when the fund started out. If those of you with decent memories may recall that when Teachers began, it held a portfolio of untradeable Ontario bonds. And the first actions at Teachers was to use derivatives to get out of the Ontario bond market and into foreign markets. And if you go to the internet and type my name, you'll find an article that says, Teachers risks all with derivatives. I was an innovation skeptic. I questioned, that column got me a call. Why don't you come on up to North York? I ended up at a bar called The Slug. Has anybody else? It was a bad British, and Bob Bertram taught me the derivatives were not going to blow up Teachers. It was all going to be okay. Here we are a few years later. The goal is $300 billion in assets. And I'm fascinated on how you're going to get there. And I thought I'd start by talking about Teachers' kind of role as an innovator. As you said, the Canadian model is established, but Teachers should take, and Teachers' leadership should take a great deal of credit for blazing that trail. You now face a demographic issue that eventually other plans will face. Your workforce, the Teachers of Ontario, they have the wonderful habit of living quite long. They tend to be over 30 years of benefits from the plan. You've got a lot of teachers who are over the age of 100, still taking a pension, and your workforce is still relatively the same. So you now have far more members collecting a pension, or not more, almost as many members collecting a pension as you do actually in the workforce. So how does Teachers change the way it thinks about investing and about running how do you as a CEO change the way you lead the fund as the fund matures? And what lessons can that offer the other Canadian plans and all of us as we head to retirement?
Well, thanks, Andy. I could spend a long time on this question. I'll try and be succinct. I think that the central pivot point is actually your appetite for risk. So I mentioned it earlier, but with the demographics of our plan, as I said a minute ago, we can't take too many risks. But we are in the risk business. So every investment we make probably has some element of risk to it, by and large, unless we're buying government bonds, by and large. So I think the challenge for us is to try and say, in our investment activities, what is the right balance in our portfolio to actually say we can generate the returns needed to keep the plan fully funded and grow the assets towards that $300 billion North Star number. But also, we're taking the right level of risk so that we're not going to, so back to your point, blow the plan up. In the main, what we've been able to do more recently, I think, is navigate some big shifts in products like fixed income and private assets and really go to assets we think give us the characteristics we need. So if I picked a couple, we're very long in inflation-sensitive assets because we feel that inflation is a big challenge for our plan. All the pensions are inflation-linked, so our liabilities go up with inflation. So we have around 40% of our portfolio in those types of assets. And I think that has helped us back to the point of navigating the first half of this year reasonably well. Still early days in terms of navigating, I think, challenging markets. The second point, if I could say it, is that we need everybody in the organization to feel it's a safe culture to take a risk. And I think where plans struggle is that if people try to innovate or try out something new and get highly criticized for it, then you won't do it again. Mm-hmm. And Teachers is a fabulously successful organization. My job, under what I've defined as the Teachers 3.0 strategy, is to evolve it to the next stage of expansion, which will involve some change, and that can be challenging.
There's an interesting political environment right now around ESG and around the investments that you're making, the impact investments that you're making to help the environment. I'm thinking specifically, if you've been following the US news, of certain politicians, Ron DeSantis in Florida, some of the Texas politicians. They're sort of saying, look, funds that we sponsor with state money should have almost an anti-ESG bias. They feel that ESG is a woke political movement. You're talking about the fund demonstrating lasting value, not only for performance, but as a force of good in markets. Can you just talk a little bit about what you would say to what I perceive as a bit of an ESG backlash that pension plans like Teachers, that fund managers like Larry Fink at BlackRock, they're facing? How do you marry up the ESG obligations of the fund along with your mandate to generate sustainable performance?
Well, a couple of comments. I think within the ESG discussion is the question of trust. So trust is very hard to gain and really easy to lose. And when we talk about climate impact, we have to make sure that we're walking the talk every time in what we invest, that it's consistent with what we've said, which is a core component, I would argue, of our branding. The execution of ESG issues is not easy. Mm-hmm. We've been known for quite a long time of being, I think, pioneers of strong governance around the companies we operate in, whether it's public or private companies. But I think the newer areas, the S and the E, are really coming to the fore. I think on climate, the most interesting thing we're grappling with at the moment is, at one level, there's a range of views across our membership about whether we should be in fossil fuels, should we have them, should we divest from them. That's a perfectly good discussion to have. Our view is actually those companies are more likely to decarbonize with our ownership than if we hand it over to somebody else. But it's not easy to do, and we have to make sure that we have the skills, the money, and the time to allow those businesses to do the transition. On the social side, there's been a lot of debate within our firm, and I think there is going on more broadly now. Teachers' approach has really been for a long time. We've always tried to do the right thing, as you might describe it. But that's not good enough. We have to be more granular than that. And really what we're trying to do now is actually saying, what are the things we can do to essentially level up inequality in the communities that we work with around the world? That's not going to be the 50 countries that I was mentioning, but it probably will be in the 9 to 10 markets where we've chosen to have a specialist involvement.
Let's talk a little bit about the high carbon investments, because you were out with a publication this week on the website that says It was actually a wonderful discussion of where you're going on a lot of different fronts, but the one that caught my eye was a $5 billion commitment to high carbon transition assets. Do you want to just talk about like what that might look like and how you'll answer to members that feel you shouldn't be involved in fossil fuels at all?
So I'd encourage everybody, if you haven't had the opportunity, on our website there's our Responsible Investing and Climate Report. It sets out a lot of our thinking and our objectives around how we're trying to tackle these areas. For the high carbon assets that you just mentioned, Andy, we've set aside a notional number of about $5 billion. And in the size of businesses we're likely to be working with, that's probably 2 or 3 investments. And what we're going to do is make sure that when we look at those investments, we can deliver what we're hoping to deliver, which is we're clear about what needs to change. We can help those businesses to execute that transition. And actually, at the end of the day, they are significantly lower emitters of carbon. And to give you an idea, the average emissions from our portfolio is about 30 tons of carbon per asset we have, dollar asset we have. These higher emitting businesses will be over 300 tons. So 10 times the criteria that we have generically through the portfolio. So coming back to the point of are we being brave, I think we are being brave because we're actually putting our marker down to say we want to take on these businesses to proactively help them decarbonize. We could leave them to somebody else and they'd say it's your problem, but the evidence we've seen so far is somebody else isn't doing anything. So we are taking the view that it's more likely to happen under our ownership than if it were left to somebody else.
And Joe, would you have lower investment targets on those assets, or would the investment targets stay the same, but there's also the social benefit that you talked about?
Honestly, I would personally say this. I mean, our investment team, some of who are here today, probably give me a different view, but I would say that there's a base level, the return should be the same.
Right.
And in some ways, you should, in many ways, be looking for a larger investment return because they come with reputational risk.
Yep, good point. As we said right from the start, this is your event. I'm thrilled to ask your questions, and I've come up with a couple of questions from the crowd. Joe, you said the plan leans on innovation. Today, Canadian institutional investors are underinvested in the life sciences compared to U.S. pension plans. Growing the Canadian life science companies is basically good policy for this country. How can we reduce the impediments to investments in Canadian life science and create more value in Canada?
Great question, whoever asked it, so thank you for it. I would say, quite honestly, we're a bit underweight in medical and life sciences too. I think the reason for that is really one of scale. If you think about it, we generally like to invest in probably above about $100 million in any business. And there are lots of fantastic life science companies which are below that size and valuation threshold for us easily to embrace them. We try to look more flexibly through our Teachers Venture Growth team, which I mentioned earlier, and they have done some things in this area, absolutely. I think the challenge in life sciences, and to be honest, I think in Canada more broadly, is how do we work with other local investors to be essentially the second or third provider of funding to really try and scale a substantial business. That's probably where we're at our sweet spot.
You mentioned the Teachers Venture Growth, and I really love the investments. If you haven't seen the portfolio, Joe's got an investment in Elon Musk's SpaceX, which is, I think, really cool. How do you think, though, about those disruptive technologies? And you mentioned reputational risk, too. I mean, the case stubbed their toe on an investment in a crypto company. How do you think about cutting-edge companies where obviously the chances of success mean really outsized returns, but there is a much higher chance that it goes to zero? How do you think about investments in venture?
Well, the first thing to say to everybody in the room is I'm not trying to get a ticket to Mars. Though I would quite like to go, but that wasn't the argument. These companies have risk. So we have to be thoughtful about are we comfortable we can assess the level of risk and it's appropriate for a plan like ours. I also mentioned earlier we want to get paid for the risk we take, and we found to date that of the assets we've accumulated in our teacher venture growth team, about 20, as I mentioned earlier, they've done really well. They generated a 40% return last year for us, which is fantastic. So what's the point here? I think the point for us is to say, when you are often dealing with a venture business, the key question I've always found, and I did do some venture investing back in my youth, I suppose you could call it that, is that you need to understand the competency and capability of management to execute the plan. Everybody tends to look at the technology or the market and spend a lot of time with consultants trying to get, is there a gap? Is there room for growth? But actually, to me, the overriding link to success around these type of venture business or growth equity business is, have you actually got a great founder or entrepreneur who can drive the business forward? So Elon Musk is a case in point. Unusual guy, but you look at what he's done across multiple businesses. Absolutely. He has got something special about him.
Yeah, that makes sense. I'm going to take another question from the crowd. You talked about some of the challenges we're facing. In light of recent market downturns and soaring inflation, are pension funds still sufficiently capitalized? Do you see underfunded pension plans being an issue going forward?
Well, I'll be careful about talking for others. Let me start with that statement, if I may. What we do in our plan is actually we try to think not only in terms of what you heard me talk about, which is generating return to grow our asset base closer to that $300 billion North Star, where we should have enough asset and liquidity to be able to fund the pension contributions we need to make. What we also have to do, because we administer the plan, we also need to think about the liability profile of what we're working with. And sometimes those don't always move in tandem. So we are thinking more carefully now, given we are having a rising interest rate and inflationary environment, about looking at our liabilities and saying, how do we try and insulate that risk as well as much as we can? And we start from a premise of we're trying to leave the existing arrangement we have with our stakeholders as it stands in terms of contributions in and payments out. But it is a challenging funding dynamic, and I think that's why the team has to be on its mettle every day to perform.
And I'm interested in the way you think about global markets. You've built offices elsewhere. You've got offices in Asia. You've got offices in Europe. Do you expect, and you've always had a culture of being a direct investor as opposed to hiring outside managers. So when you look at the global market, first of all, do you expect to increase over time the global exposure of the fund? And secondly, when you think about Australia or India or South America, will teachers eventually have teams in those markets? How's global growth going to shape?
I think I laid my marker down fairly early on to be chosen as CEO of Teachers that I believe in international investing. That has been my background personally, and I very much introduced some thoughts strategically before I became the CEO of Teachers that actually that to me was the right thing to do essentially for our growth. Within that, you're really looking at the logic of saying diversified investing is better. Access to different countries and markets is better because they move with different growth rates, different speeds. And you learn more actually by being an international investor than being a local one. We've got an objective, particularly around our private assets, to have essentially a 50-50 balance between North America and other international markets. And that's a really big challenge when you add in the weight of the Cadillac Fairview local portfolio and real estate and some other North American-based assets to see that sort of shift over time. Where will we be in, say, 10 years' time? It's hard to say. I think we're finding increasingly, back to my geopolitical comments, that actually if you're a fly-in investor from abroad, it's becoming more challenged to be taken seriously as a credible asset owner and manager. And politically, there are a number of changes that are happening in markets we like and we've been operating in for a while, where clearly the new government is saying, I'm not so sure that foreign investors are what we want for certain types of assets. And where that gets most complicated, I would say, is probably around things like infrastructure, particularly strategically important infrastructure assets, where we'd like to be an owner, and we have to persuade ourselves that we're the right choice.
I'm going to go with one final question, and then there is just a minute or two left. Anybody who wants to get a card in, that'd be great. But look, as Canadians, we're always fascinated with how others see us, how Americans see us. You're a relative newcomer to this country. Obviously, you've been with teachers for some time. But what have been your observations on doing business in Canada? Any big surprises on coming to this market and this business community, or?
This is potentially the question, Andy, where the trap door opens between myself.
That's what they pay me for.
Seat. Well, let me start by saying I married a Canadian lady.
Well done, sir.
So I'm a bit more Canadian than you might think. If I talk to my children, certainly my daughter would see herself more Canadian than from the UK, I think it's fair to say. I think Canada has enormous strengths, and it's going to help it navigate some of the turbulent waters we see well over the next couple of years. When you start with all the asset base it has in oil and gas as well as commodities, very well placed. If you contrast Canada to what I see from where I came from in the UK around energy prices and energy risk, you don't have the same, I think, pressure around electricity, particularly prices. And I think that's a huge help, again, in terms of a stability in the local market and the world. One might be a little fearful about house prices, I guess. They seem in certain locations, certainly here, to have gone up significantly in recent times. I think that would be one to watch out for. But I should probably conclude this question by saying, I'm actually working way later than I ever thought I would. And I'm doing that because I'm working with people I really want to be with. And they give me energy and enthusiasm every day of the week to come into the office and try and do better. And I think that's probably the best thing I can say about working with a Canadian team and a Canadian environment. There's so much that they bring to the table that make you a better person every day. Well, if there's no other questions, I think that's a wonderful note to finish it up. I have had the pleasure of covering the Canadian model as it evolved, and I've also had the opportunity to travel around the world. Canadian pension plans, with teachers as a leader, they are our calling card. They are some of our best ambassadors. They are world-class capital pools. And I commend the Canadian Club for giving us an opportunity to hear from Joe and to sort of celebrate what we're doing and then better understand where things are going. So it has been my honor to be up on stage today, and thank you, Joe, for taking a few minutes with us. Paula?
Yes, very much thank you. My name is Paula Allen. I'm a director with the Canadian Club of Toronto, and it is my absolute pleasure to thank our first guest of the season, and what an incredible conversation. Thank you. Mr. Taylor, on behalf of the Canadian Club, it's very inspiring to hear your vision and what the work that you do, the international expansion, the innovation, the impact. And as the daughter of Avery and Rupert and the daughter-in-law of Elsa, educators in Ontario who are healthy, happy, and very secure, I thank you for that as well. It makes a difference. It's very clear to see why the Ontario Teachers' Pension Plan is an enviable one. But I was also struck by, not only your vision as a CEO and your passion as a CEO, but several times, you might not have realized that, but I was keeping track. I keep score of things. There's several times that you mentioned your team, your talent, the people that you work with. That makes a difference, because that is what's going to bring that sustainable value. And also the importance of the impact of the work you do, not only the constituents, but the social good. So many things to thank you for in addition to your time here today, and wish you continued success in your leadership in one of the most successful pension plans in the world. And Andrew, you're always welcome back. Such a skilled moderator and a wonderful partner to chat with at the table. And we all forgive you for your egregious error. But don't stop. Because you hold people accountable and make them explain their decisions over drinks in a bar. But again, truly thank you for your skill in moderating the conversation. And very much thanks to our tireless Canadian Club staff for making sure that there's always value, to our members, to our sponsors, and our guests are well taken care of. And particular thanks today to PwC and McCarthy Tetro as sponsors of today's event. It could not happen without their support. So thank you all, and I'm hoping to see each and every one of you, plus all of your friends back, maybe a bigger venue, to some of our other events. On September the 28th, we'll have Aaron Corey, CEO of Canada Infrastructure Bank, joining us. On September 29th, our lineup will feature a stellar panel on the insights in Canada and the world's economic outlook. So I will definitely not miss either of those. And also thank you to our partners in AV, Val Vankenberg Communications and livemedia.ca. So I hope you had an inspiring few minutes, and stay safe and see you again soon.